Hello and welcome to 15 on Friday. Today's topic is going to be regulation crowdfunding. It's a form of investment offering that became available in the United States as of 2016 when the SEC created the regulation crowdfunding rule. These offerings are typically called Title III offerings, and what it allows is a form of crowdfunding where instead of backers getting perks for putting money into a company's project or perhaps a discount on the first production run of the product, they can actually invest either in convertible notes or actually purchase shares in those companies. This wasn't available to the average citizen up until 2016 because you had to be what's called an accredited investor in order to invest in a private company. An accredited investor, and it's a little bit more complicated than this, but essentially, accredited investor needs to be worth about $1 million or earn $200,000 a year in order to invest in private companies. The reason for this is because of the risk that's involved. The SEC has said that it's highly risky to invest in private companies. Their stock isn't publicly traded, which means that it's what's called illiquid. It means that it's very difficult to sell shares in private companies as compared to stocks that are traded on public exchanges. So if you aren't worth an obscene amount of money, then the risk of not being able to recover your investment outweighs the benefits when it comes to possible loss. That's where the SEC rules came in terms of accredited and non-accredited investors. But as crowdfunding became more popular with sites like Kickstarter and Indiegogo, where people were essentially funding the startups of these new ventures, all they were getting out of it was a product or a perk. Maybe you get a T-shirt and a thank you. And these companies raised money, launched their products, and they were off and running. The people that put the money into those projects didn't really get a lot back if those companies succeeded. If you were an accredited investor, you could back a company just like that, and you could actually participate in that company's success through owning shares in the company. So as of 2016, the SEC opened up a new rule called Regulation Crowdfunding that allows crowdfunding investment offerings. There are some basic rules. All of the offering details have to be hosted on an online portal website. And all of the details must be there. And once the offering is open, those offering details cannot change. There are rules about how much an accredited investor can invest. Typically, it's a percentage of their annual income up to a certain amount. And there are rules about how much private companies can raise in a Title III offering. It's currently $1,070,000 is the absolute maximum that a company can raise through a Title III offering. That's in a 12-month period. Where do we find places to invest in Title III offerings? There are many websites available. They're called portals where these offerings are hosted. Currently, according to the website Crowdfund Insider, there are 41 active regulation crowdfunding offering portals. You can check out crowdfundinsider.com. They actually cover news related to the crowdfunding industry. They're covering new topics like cryptocurrency and blockchain technology and things of that nature, but they also are covering the global industry of crowdfunding. They track new Title III offerings that have been registered with the SEC. They track the various portals that have offerings active. It's an excellent source for current information about the crowdfunding industry as a whole. Now, with 41 crowdfunding portals currently active, you'd think that would mean, gosh, this is huge. There must be thousands of offerings going on right now. The fact is that there are probably 5 to 10 crowdfunding portals that are raising the bulk of the money in the United States. Right now, Start Engine and WeFunder are two of the largest. There are some others like Seed Invest and True Crowd and several others that are also hosting several offerings. There's a website called Crowdits that actually tracks most of the major platforms in the United States. and publishes weekly reports on the amount raised by portal and by individual offering, and also covers the total amount of money that was raised through investment during each week, and then monthly as well. According to Crowdits, there are currently 203 active offerings. As of a couple weeks ago, that was actually 204, so one of them may have closed. Typically, these offerings will run for 2 to 3 months at a time. They can run longer, but when you're trying to raise a maximum of $1 million, there's a limited amount of time that it can actually be worthwhile to keep an offering open, and that's part of it. The companies that have active Title III offerings going have to pay a commission to the websites where they take their investments. And that commission is specified by the SEC. It's allowed. The idea of it being $1,070,000 as the maximum amount raised, as opposed to $1 million even, is that the $1,070,000 accounts for the commission that those portals would take in order to host the offering. And that's not optional. The portal online website or portal is where these offerings must be hosted. And the idea is that for non-accredited investors, that they have access to all of the information that will be presented about the offering to anyone, whether they are accredited or non-accredited investors. That way, there's no confusion. There isn't some of the shady tactics that unfortunately sometimes happen with private investment offerings, where you don't know what you're hearing about an offering and its success, whether or not that's the exact same thing that another investor is being told. There's an amount of due diligence one should do before investing in a private company, and as a non-accredited, maybe a little bit less sophisticated investor, you wouldn't have access to that information or that kind of time if you're really only going to be investing a few $1,000s. And annually, the maximum amounts for a non-accredited investor are in the few $1,000 range. But so by having all of the offering details posted in one place on one portal, and they can't change without what's called a material change to the offering that allows any investors that had made investments up to that point to back out if they want to. It protects the small investor, the little guy. That's the idea behind these rules. So I recommend, if you're interested in checking out some of the offerings that are active, Crowdits is an excellent website, and as I said, Crowdfund Insider is another one that is an excellent place for news as it relates to the crowdfunding industry globally and in a more financial sector sort of sense. But let's talk about for a minute investing in a startup via Title III crowdfunding opportunity. There are some things you should consider. Okay, first of all, I think it's wonderful. The idea that someone like you or me, frankly, could not have made an investment in a company like Facebook, back when they were in the seed funding stage, whether we recognize the value of that concept of social media at the time or not, we couldn't have made that investment because certainly I was not an accredited investor. And even if you wanted to, even if you were accredited, you would have been talking about putting in serious amounts of money to make that investment. So you may have recognized the value of the platform, the value of the technology, the opportunity in the market for it, but you couldn't have participated in that success because as a non-accredited investor, you just wouldn't have been able to get in the door. What does that mean? That means that the guys that already have money, the power wielders, the oligarchy, are the ones that continue to reap the biggest rewards for recognizing innovation and recognizing new directions in technology and in the marketplace. Keeps the little guy shut out. So frankly, the regulation crowdfunding to me is an excellent thing that the SEC has done. It was opened up through the Jobs Act in 2015 and then became, I believe 2020 12, and finally became available in 2016 for not accredited investors to invest. Now, of course, just because that's true doesn't mean that you can invest in a company, in any private company that's seeking seed funding. They have to be running an active Title III regulation crowdfunding offering in order for you to do that. But it's an opportunity. But the question is whether or not you should. And that's a question you should absolutely take very seriously, because while many of these offerings will have a minimum investment of $100 or $200 or $500, you're putting money into what's considered a long play investment. It may be speculative. It may be that you really see the value of the company and its business model, and perhaps they even are already showing revenue. But most of them are in the startup stage, and you're looking at a long play thing. You could be putting $500 into a company, and you need to expect that it could take a year, 2 years, 3 years before you see a return. The value of that, the value of investing in any business at a startup stage, is the fact that you get, an investment value that's much lower than once a company has already achieved success. Once a company has an IPO, or they're in revenue, they're turning a profit, and they're traded on a public exchange, now their stock is valued based on some proportion of what they're currently earning and what they will be earning in the future, or what the marketplace thinks they will be earning in the future. That overall value is typically higher than when you're investing at the startup stage. It is a gamble in some senses. It's definitely a speculative. You think this company is going to succeed, but there isn't at that stage necessarily any supportable evidence of that in terms of current revenue and things like that. So typically you can get in at a low share price, or at a low investment amount, with the potential for it to explode huge. But you need to be willing to wait for that. Could take a year, could take 2 years, could be even longer. Now, as it does, and as those startups go through multiple rounds of investment, from Regulation A, and then through multiple, new rounds, there typically are stock splits. Suddenly, you bought 500 shares, it becomes 1,000 shares or 1,500 shares, and it keeps going. And then by the time you get to an IPO, you could really be doing very well. But the company could also never succeed, and you need to be prepared for that. So when I talk about considering whether or not you should invest, you have to consider whether or not you are willing to be a long play investor. You're looking at a company that has a product that has potential. You're looking at a company that has revenue potential. You're looking at innovation that you think will take a marketplace in a new direction. And you're willing to wait for that to happen. You're willing to take a shot and reap benefits down the line. If you're looking for profits tomorrow, Title III investment is probably not for you. Number one, there is a rule that you have to wait a year before you can dispose of your shares in most situations. Now, if you passed away, I believe you could actually bequeath your investment to an heir. But in general, if you purchase shares through a Title III offering, you're going to have to wait at least a year before you can dispose of those shares at any rate. So you're definitely talking about a long play. And so when you decide how much you're going to invest in a company, if you think you want to invest in a company through a Title III offering, definitely need to be thinking about how much can you afford to put on the back burner? How much money can you invest and not miss for at least a year and maybe longer? And that's important. These rules are put in place to protect non-accredited investors so that they can't lose too much money. The maximum amount you can invest, in any given 12-month period as a non-accredited investor is limited, so that you can't just completely go flat broke by making speculative investments. But at the same time, even if you invest $1,000 and that's within the limits of the non-accredited investment rule for you, it's really hard sometimes to put $1,000 away and say, I don't know if I'm ever going to get that back. You need to be thinking about that for sure. It's definitely a long play investment. But here's some things that I would say you should be thinking about. When you take a look at these platforms and the offerings that are available, you want to be looking for, number one, products that are innovative, that are doing something new. You want to see a product that has that's in an industry that has a sizable capital, and that has a potential for near-term traction of some kind. If the company's in an idea stage and they really have not even developed a working prototype, or they haven't developed the product yet, that's a little bit riskier, because you don't know, even if after you put the money in, they will actually get a product developed. You want to see, some kind of near-term plan for some kind of traction, whether it's user adoption or some kind of revenue generation, even if that doesn't equate to profitability. You want to be able to see that kind of growth sooner rather than later. So I would be looking for companies that have a plan that makes sense for some kind of near-term growth like that. And a lot of times that might be something as simple as a test period, or a trial period, or an initial manufacturing run that may be small, but it can validate the product that they're developing. And it may also allow those companies in those small initial programs and rollouts to learn something they didn't know about the way they need to improve their product or their software or their platform or whatever it is that they're developing, to take it to that next level. So, what I would be looking for is, not necessarily massive profits right out of the gate, but definitely some kind of reasonable traction. Another thing I would avoid, and this is just me, is really any kind of offering that is built on buzzwords. And by that I mean there really isn't a product there, or it's not very clear what it is they're going to build, or how it's going to incorporate whatever that buzzword is. One that has been very popular ever since Title III investment came on the scene, especially starting in 2017, has been blockchain technology and cryptocurrency. That has been very popular across the board in the United States in terms of the investing market, and it's been kind of ridiculous. People have been throwing the word blockchain into every kind of business imaginable because it's a hot button word, it's a buzzword, it's a trending word. Frankly, most of that is bullshit. Now, you can invest in blockchain, and I'm not saying you shouldn't do it. There are legitimate uses for that technology. But an offering that is sound, a company with a sound business model, is going to move beyond buzzwords to explain what their product does and how it improves their marketplace. If they can't do that without using these buzzwords over and over again, then I would stay away from them. Because even if the idea has merit, they aren't presenting to you. Even perhaps they do, know how to make money, but they're definitely not presenting it to you in a way that's reasonable. And that leaves too much room for them trying to pull one over on you. And if it was me, I would avoid that. It's just not worth it. And unfortunately, just like in any kind of crowdfunding platform, whether it's equity crowdfunding or even on Kickstarter, buzzwords are out there, and people are trying to use smoke and mirrors to get people to back their ideas. I would avoid that as an investor. Look for companies that have a real product. Hopefully, they've developed some proof of concept or some kind of product prototype. That they should have a sound business model. I'd be looking for a strong team too, a team with experience, and by that I mean founding team or a C-level executive team that has experience within that marketplace, because you have a higher chance of them succeeding or taking it somewhere, and of course, historical success is no guarantee of future success, but it's good to know that that a team has that a company has the right team in place with a track record of knowing how to make a company profitable or knowing how to get a company rolling. So I'd be looking at that. I'd be looking again, like I said, at near-term results of some kind. So that's Title III crowdfunding in a very basic, short explanation. As we go through the next few weeks, I'll probably be talking more about it. I've actually worked on the promotion of a few Title III offerings. Last year, we successfully closed a Title III round for a tech startup I was working with, where we raised close to $1 million. Most Title III offerings do not get near that cap. I'm currently an advisor for a company called Proctor 360, who has an offering active now on Start Engine, and I'll probably be talking with them in one of these videos very soon as well. But I encourage you again to check out websites like Crowdits and Crowdfund Insider to learn more about the offerings that are out there, and then go to the platforms themselves like Start Engine and WeFunder and all of the others that that have offerings available. Just because a platform is not as large or isn't one of the heaviest hitters doesn't mean that there might be a real gem of an offering sitting out there. Now, it might be, my advice might be different for a company wishing to raise money through a Title III offering, and we'll talk more about that in future videos. Obviously, if you want access to a large investor pool, you want to consider at least the most popular platforms. But there's also a hitch in that giddy up because those users are also bombarded with more offerings, and so you get diluted in terms of your individual offering when you have to compete with a lot of others on a bit larger platform. So there are more considerations, and we'll talk more about that in coming weeks. And we'll continue with these videos to talk about other topics in marketing and startup and entrepreneurship as well. But thanks for tuning in, and we'll talk to you soon.